Welcome back to another episode of Travis, Can I Have This? Today, we are talking about one of everyone's favorite topics, and that is taxes. Specifically, getting a tax surprise. And right now, we are in this weird land of taxes. The time between January 1st and April 15th of every year in the United States, we start to put together our taxes and we start to find out how much we actually owe or if we'll get a refund. And if you're a doctor, especially if you're in the early stages of your career, or if you've experienced some kind of change, like you bought a practice or you had some big bump in your income, you often get a tax surprise this time of year. So before April 15th, after January 1st, you get this tax surprise. You owe a bunch of money in taxes, and your mind is blown. Like, holy crap, I owe how much in taxes? We call this the school of hard knocks. You're learning the hard way the impact of taxes, and your mind is going all sorts of places. Now, ideally, in a perfect world, you are doing tax projections during the year so that you kind of know what your taxes look like ahead of time, but not everyone has done that. And you learn the hard way why it's important to do that. But today I want to talk about 7 things that you can still do before April 15th to save money on taxes. And these are things that you can implement. Some of them you need to do before April 15th. Some of these you can even do after April 15th, as long as it's done before you file your tax return. So if it's after April 15th, you'll need to go on extension to do some of these. But I got 3 quick disclaimers before we get into number 1. First, this is not tax specific advice for you. I don't know who you are, exactly who's listening. It's probably my mom, nobody else. Just joking, mom. Hey, but whoever you are listening, you do need to talk to your CPA because there are some nuance to some of these in the implementation side of things. But it's definitely a discussion that you want to have about some of these things. I will say this, it's not part of my disclaimer, but as an accountant, right now, we are so busy preparing taxes. And I can't wait for these AI agents to come in and prepare these tax returns, honestly, so that we can be more strategic and focused on the needs of our individual clients. That is more nuanced and harder to do. But until then, we're really, really busy. And so a lot of times as accountants, we have a hard time being strategic with you at this time of the year. We can be a lot more strategic in the summer and the fall and the end of the year, but in tax time, it's really, really hard, if I'm being honest. So it's not out of place for you, if you have a CPA, to bring these things up and start a discussion. And even if your accountant rolls his eyes and doesn't want to do it, you need to kind of advocate for yourself to save as much as you can on taxes. My second disclaimer is this will in no way, the 7 things that I'm going to go over, they will not eliminate your taxes. And I think it's a very helpful exercise at some point in your life to look at the United States tax brackets and get familiar with that. And if you're making $500,000 a year, you should be expecting to pay 30% in taxes. Now, are there things here and there that you can do to save money on taxes? Can you save $2,000 here? Can you save $5,000 there? Can you save $10,000 somewhere else? Yes, potentially, right? You can do things to save a decent amount of money in taxes, but you should not have the expectation that you're going to eliminate your entire tax liability. So we'll go over some of these and I'll talk about some of the savings. And there's definitely thousands of dollars of savings that I will discuss. But if you're in the camp of owing $100,000, it may be difficult to eliminate that size of a liability based on these tips that we'll go through today. And really the unfortunate thing for you is the lack of planning and preparation, and hopefully you can do that better next time. The third disclosure is that several of these strategies will require cash. So you have to put money into something to save money on taxes. It will also require you to value retirement plans. So a lot of these are going to be retirement plan related, aka putting money in, saving for your future, and not touching that money for several years. And meanwhile, that money grows. Philosophically, some people disagree with retirement plans and the structure of that, but really they're set up to incentivize you to put money in today and save money on taxes today. And there's a whole philosophical debate around retirement plans, but we won't go into that. We'll just focus on the tax saving side of those things. All right, number one, fund your HSA, aka your health savings account. Now, you need to have a certain type of health insurance. Now, it's too late at this time of the year to enroll in that type of health insurance that would qualify you to fund an HSA for the prior year. But if you do have an HSA eligible health plan, you want to fund an HSA account or health savings account. Now, just kind of high level, there's different nuances to what makes a health insurance plan a HSA eligible plan. Typically, if you are an individual and your health insurance deductible is more than $1,600 per year, or if you have a family plan and your deductible is more than $3,200, you can probably qualify for an HSA, but you should go to your health insurance carrier and they should be able to tell you if it's HSA eligible or not. But the thesis is if you have an HSA eligible plan, make sure you max that puppy out. We'll probably do an episode someday just on HSA plans and how awesome they are. There's so many fantastic, beautiful, wonderful things. It's like eating your cake and having it too, whatever the saying is, I don't know. But HSAs are awesome. So max that thing out. So you could put up to $4,000 and some change in an HSA plan for 2024 for last year. Or you could put $8,300 if you have a family plan. This changes every year slightly depending on when you listen to this. So make sure you check what you can do, but you can fund this up until April 15th of every year. So you can fund your prior year's HSA balance before the tax deadline, and it still help you save money on taxes. So let's pretend you have a family plan, HSA eligible plan. You haven't funded any money. I'm actually in this boat, honestly. I need to fund my HSA. If I fund my HSA, I put $8,300 in that. Let's just use a nice round 30% tax. Let's assume you're going to pay 30% taxes. That would save me $2,500 on my taxes. So basically, all I did is I moved money from a checking account into a special savings account. It's still my money. I'm just moving it from one account to the other, and I saved $2,500 for doing that. Now, there's certain rules around what you can use the HSA money for, but there's actually some flexibility in that. We'll talk more about that later. Max fund, do the maximum amount you can in your HSA is what everyone should do. As I tell you, everyone's situation is unique and different, and consult with your CPA. But I think there's a lot of strong arguments on why, if you are eligible for an HSA plan, you should definitely consider funding that thing. Number two, fund your IRA. Now, IRAs are interesting, and I intentionally left that comment somewhat vague because there are traditional IRAs and there are Roth IRAs. And there's a fun thing called, it's like an informal backdoor Roth IRA. And depending on what kind of IRA you have will depend on if it will actually save you money on taxes. For example, funding a traditional IRA will typically save you money on taxes. Funding a Roth IRA will not save you money on taxes today, but that money will grow tax-free and you can pull it out later. For most doctors, the thing that you want to do with an IRA is what we call a backdoor Roth IRA. The reason being is if you're married and you make more than $250,000 a year, and I think for most doctors, Hopefully you're making more than $250,000 a year. If you're in that boat, you cannot fund a traditional or a Roth IRA. You exceed the income limits. However, there is a way for you to get money into a Roth account through a traditional IRA. So it's a loophole. It's very commonly known. The IRS knows about it, and they've effectively said they accept this backdoor Roth IRA loophole. But it's something that I think most doctors should be doing to get money into a Roth account. Now, the most that you can do in a year, for example, for last year, it's a $7,000 contribution limit. Unless you're over 50 years old, then you can do a little bit more. But let's just say $7,000 a year. That will change every year based on inflation. But it's not a crazy amount of money, but it's just something that you should do. Put money in that Roth IRA. If you do it every year over the course of 15 years, you will not regret the amount of money that you have in a Roth account, the tax-free nature of that money, and the flexibility that gives you into retirement. It will be a very, very good thing for you to do. And there is still time to do it. So you can fund your IRA by April 15th. And I probably haven't given you a lot of details if you're not familiar about a backdoor Roth IRA on how to exactly do that, because it's a little bit of a longer discussion. But just know you should try to fund an IRA, and you can do that by April 15th. Now, in all of the cases of these 7 things that I'm going through, I want to talk about on each one of these how much these will save you in taxes. This is one of those things that honestly won't save you any money in taxes, especially because you're trying to get it to a Roth. But it's still something that you should do that is reported on your tax return effectively, and that can help build you long-term wealth and give you tax benefits in 20 years from now. So 20 years from now, come back and say, hey, thanks for that backdoor Roth nudge in 2025. Really appreciate it. But you won't regret it. And it's not so much money that is going to require a significant sacrifice for most doctors to make this happen. You do have to be careful there. Again, there are a lot of nuances. If you're doing a backdoor Roth IRA, there's a prorator rule that you have to be careful of. So this is something you definitely want to know more about, probably have somebody helping you do this, but something that should be on your radar for sure. And it's not too late to do it for the prior year. Number 3, this is for people who have a 401k plan in your office, which a lot of practice owners do. With a 401k plan, you often have a profit sharing component. And depending on how your 401k plan is structured, there are lots of different ways to structure your 401k plan, but you should consider maximizing your profit sharing portion of your 401k plan. And what I basically am talking about with this is, with a 401k plan, there's really 2 components. There's the employee who is deferring money into their 401k plan. So in 2024, the most they could defer is $23,000 in a year, unless they were over a certain age. So that's one component, is the employee deferrals. The other component is the employer's portion. And the employer, the most common terminology is the employer match. The employer matches a certain portion of what the employee puts in. But there's actually a lot of different ways to slice the employer portion. And if you have a well-structured 401k plan, you should have what we call a minimum amount that you have to match, and there's a maximum amount that you can match. And ideally, the maximum amount that you can match should be structured in a way that gives the owner the biggest benefit. And you want to look, if you have a 401k plan, before you file your taxes, it would be great for you to know, what is the minimum amount I have to fund and what is the maximum amount I have to fund I could fund in my 401k. And depending on your tax situation, you may want to do the maximum amount. If you're in an extremely high tax bracket, that maximum amount that you're funding the 401k may significantly help your taxes. So for a lot of our clients, that's the last thing we look at. We say, hey, let's do all your taxes, all your other strategies, And then let's look at this 401k piece. What's the minimum amount? What's the maximum amount? Where are your tax brackets? How much bang for your buck are you getting for max funding this? And everyone's going to be in a different situation, but it's something you want to look at, and it's something you can decide all the way up until you file your tax return. So not even before April 15th, if you go on extension, if you're an S Corp, you go on extension all the way till September 15th. You could wait until then to decide. Hopefully you don't wait that long. But sometimes these 401k companies take a little while to do their calculations. So you can give them some time to do their calculations, run some numbers, make this the last decision, and decide if you want to do the maximum amount or minimum amount. But just know there's still time in the year after to kind of play with these numbers and figure out what you want to do. Number 4 is another retirement plan account. This one is called a SEP IRA. Some of you may have heard of this. A SEP IRA is typically really good for a 1099 associate or a 1099 contractor. SEP IRAs tend to become less favorable when you start to have employees that you also have to give or participate with the SEP IRA. Now, if you had a SEP IRA before you had employees, you can exclude your employees for a few years. There's certain requirements on you excluding your employees, but if you have to include employees into your SEP IRA, it starts to get really expensive. So usually it's really good for like a solo person practitioner who maybe has a lot of 1099 income. SEP IRAs are awesome because of how easy they are to set up, how easy they are to calculate. You don't really need a firm to help you do the calculation on this. The most that you could fund a SEP IRA is $69,000 in 2024. So it's a pretty big chunk that you could put into this retirement savings venue. And you don't have to do this really until you file your tax return. So for a lot of reasons, it's a really, really good and easy savings mechanism. And so if let's just say you funded $69,000 in this at a 30% tax bracket, that's about $20,000 in tax savings by putting that money into the retirement plan. Now, a SEP IRA. So let's just assume you prepare your taxes and you owe $20,000 and you decide to do a SEP IRA. Well, you'll have to pay $70,000 into the SEP IRA, but you eliminated that $20,000 tax liability. So you ended up having to pay $50,000 more in cash. So you had to have the cash. But now, instead of $20,000 going to the government that you're never going to see again, there's that $20,000 that got repurposed towards your SEP IRA, which is going to your eventual retirement. So again, this is an example of something that you need the cash to be able to fund it. But if you can, it gives you more long-term benefit than just paying the government today. Number 5, similar to a SEP IRA, this is another retirement account. This is a defined benefit account. A defined benefit account is for the big dogs. People making lots of money that want a really, really big retirement deduction. So this is a complicated calculation. You're going to need a firm, an actuary to calculate these types of things. But a defined benefit is like a retirement contribution that you can put into your for your future savings. And there are some nuances to this that we won't get into. But just know you can fund $100,000, $200,000 into a retirement account that could save you quite a bit of money if you're in a very high tax bracket. So this is something that can be a really good tax savings, and it's not too late to set this up. But because it's a little bit complicated, you got to get on it. You got to get a firm involved to help you do these calculations. Again, if you did $150,000 into a defined benefit at 30% taxes, that'll save you $45,000 on your taxes. So the savings can add up quite a bit. But honestly, if you're wanting to do a defined benefit, you're probably close to being in a 50% tax bracket. So putting $150,000 into a defined benefit could save you potentially $75,000 on taxes. So it starts to become a really good benefit, but it does require some costs on the administration side, and it requires a bit of commitment. You can't just pop this up for 1 year and do it and then not do it the next. Technically, maybe you can, but there's going to be some complications with that. Whereas with a SEP IRA, you can do it 1 year, you don't have to do it the next. Some of the other retirement plans are a little bit more flexible. This defined benefit plan is not flexible, but again, comes with some serious savings if it fits your profile. Number 6, this is the home office deduction. Now, this is probably best for sole proprietors. So somebody who does not have an S corporation. If you have an S corporation, you technically probably should have an accountable plan if you're going to try to do the home office deduction. But you should also probably look at doing the Augusta rule, which is another topic for another day. So really think home office deduction is best for somebody who's a sole proprietor, AKA you file a Schedule C for your business. And there's different ways to calculate this. There's a simplified method, which really doesn't give you too big of a benefit, or there's the actual expense method. I've seen the biggest benefit on the home office deduction for renters. Somebody who pays a decent amount of money in rent, you don't get a deduction on your home expenses. Like somebody who owns a home and you're able to write off your mortgage interest, you don't get that as a renter. So this is a really nice thing. I mean, you can own your house and still do the home office deduction. But if you're a renter and you're a sole proprietor, this is a really nice way to start feeling like you're getting some benefit for having a home office. Now, you have to have a legit home office. You have to know what the square footage of that is. It can only be used for work. It can't be like a dining room table that you eat on at night and work on during the day. It's supposed to be, the IRS has different rules around this. And I would talk to who's ever helping you prepare your taxes about the nuances of this. But it would not be unreasonable for someone to come up with several $1,000s of legitimate home office expenses, which would save them a couple $1,000s in their taxes. So not massive savings we're talking about, but definitely $1,000 to $2,000 of savings that you could get for your home office. And this would not require any new money to put into it. It's just kind of strategizing with expenses that you already paid and making sure that you're getting your home office deduction. And it's not too late to do that, to kind of put those numbers together and report that on your tax return. The deadline for this is by the time you file your tax return. So it doesn't necessarily have to be done by April 15th. It just has to be reported on your tax return. And the last one, number 7, depreciation. All right, when you hear the word depreciation, do you really know what it means? Sometimes I feel like it's a hard word to make sense of, but effectively you purchased something big enough that you were not able, or the IRS didn't want you to just write it all off in the first year. So you're subject to depreciation rules, which means you have to write it off over several years. You bought a sterilizer for $10,000. Well, the IRS says you have to write that off over the next 5 years. You can't just write off $10,000. You may have financed that sterilizer and you're paying for it over 5 years. So maybe that's fine. But as you're coming to your tax return and you're thinking about how much money you owe in taxes, it's nice to go look at those assets that you purchased and what depreciation strategy are you using. You can go just with the regular depreciation. There is something called bonus depreciation. And in 2024, you're able to write off 60% of that asset immediately. So if you bought a $10,000 sterilizer, you can write off $6,000 of it immediately. And then the other $4,000 you write off over the next 5 years. Or you could do Section 179 and write it all off right away. Now, I will say you may run into some issues if you are an S Corp with basis. Basis is a big thing and it always conflicts with depreciation and it can be a little bit tricky. So you always, take this with a grain of salt, but make sure you're looking at your depreciation, I think is the theme. Like, can I accelerate some of it? Do I even want to accelerate some of it? If I owe a lot of money in taxes and I had some assets there, you may want to accelerate those. But if you're expecting to have similar income next year or even more income, that may change your decision on maybe you want to save some of those deductions for a future year. But something you definitely want to look at, and you don't have to decide what depreciation strategy you're going to do until you file your tax return. So again, it's one of those things that until you file your tax return, there's some flexibility and how you can work with this. Just like with home office deduction, just with your profit sharing and doing the minimum maximum calculation. There are some things until you actually file your taxes, you can play around with some numbers and decide what you want to do. So, in summary, just know the best strategy on reducing your taxes is to try to plan ahead. And as the summer approaches, try to do some projections, work with somebody who's doing tax projections for you so that you don't have to be in a crisis mode right now when it's time to file your taxes. But there are some things that you can do. Hopefully, you found something in here that was helpful. And hopefully, you're not in this situation and you're not in the school of hard knocks right now learning about taxes and how painful they can be if you're unprepared. Thanks so much for listening. Go to the YouTube link to make any comments or other suggestions that you have on other last minute tax strategies that you may have heard of as well. Thanks so much.